This conference will now be recorded.
Good afternoon and welcome. Welcome to the Clear Lines Equity Alerts training session. I am your host, Kipp Cohen. It is Thursday, the 8th of September, 2022. I will be here for the next 60 minutes. This session is being recorded, and today we actually have a very specific topic that I will be discussing, and that is trading options. This is going to be a pretty basic session. I'm not going to get in too crazy and too depth, but I just want to kind of spend a little bit of time going over what options are and the advantages and disadvantages to utilizing them. And then we'll spend a little time going through how to find the right option and how to actually trade an option using Medved, which is the platform that we utilize, most of us. So basically, what an option is an instrument that gives you the right, but not the obligation, to buy or sell a specific stock at a specific price by a specific date. Okay. It's basically, it's a contract. It is a contract, and that contract has a value to it. And there's several factors that go into the value of an option, how far out in time, if it's in or out of the money, volatility in the stock, all of that factors into the value of the option. And the option goes up or down based on the movement of the price of the stock. So think of it as a leveraged tool to be able to trade stocks, basically. So there are two types of options, puts and calls. You would buy a call if you anticipate appreciation in the price of a stock. You would buy a put in anticipation of depreciating value in the price of a stock. Stock goes down. If you think it's going down, you buy a put. If you think it's going up, you buy a call. So those are the two basic options, puts and calls. There are strategies for those that own positions long term, where you can sell a call against your position, or what's called a covered call. So that allows you to bring in monthly premium or weekly premium. You run the risk of having the shares called away from you, but that is something that some traders use. They also, some traders will sell a put as a method to get into a stock. So if they want to own a specific stock and they're willing to pay a specific price, they could sell a put option and they may be able to keep the premium if it doesn't hit the strike price, or if it hits their strike price, then they may get those shares put to them. But those are the two options, and there are options on stocks. There are options on index index options. There are options on futures. There are options on, I forget what else, but there are several different types of options. But we're only going to discuss equity options, options on stocks. So let's talk about the advantage and disadvantage of trading stocks, trading options. So the the biggest advantage is the leverage. Okay, so let's use Apple as an example, right? Apple's a $150 stock. So if, let's say you wanted to buy 1,000 shares of Apple, okay, that's $150,000. Well, somebody with a smaller trading account might not be able to buy 1,000 shares of Apple. But you could buy 10 call options, which is basically controlling 1,000 shares, because one option contract is equal to 100 shares of stock. So I'm going to go to the option chain. And if you're on a chart, you can right click and then select option chains if you have a broker that gives you the data for the options. So TD Ameritrade should give you those quotes. So let's say I feel like in the next couple of months that Apple is going to make a move. It's on the run. It's got good charts. Okay. So I want to go out a couple months. We're early September. So let's say November. So options have weekly and monthly expiration. So you'll notice some have a W. Those are the weekly options. And then those that don't are the monthlies. And the monthlies expire on the third Friday of the month. So it's real important that you know when that option expiration is, because if the price of the stock is not above the strike of the option that you purchase, that option will become worthless on the expiration date. And you need to sell that option, obviously, before it expires. So again, an option is the right to buy or sell a stock at a certain price within a certain period of time. So we're going to go with the November monthly. Okay. And I'm going to click that to expand it. So you're going to see in the middle these numbers, and you're going to see some in yellow and some in white. And that has to do with whether it is in the money or out of the money. And what determines in or out of the money is based on the current price of the stock. So Apple is 153.94 right now. So the 150 option is currently in the money. Notice it's yellow, it's in the money. Meaning that the price of the option is less than the current price of the stock. So $150 call option, there's almost $4 of intrinsic value, real value, because the stock's almost 154. So there's nearly $4 of intrinsic value, and then there's another $7 and change. Okay, because it's 1140 by 1145 is the price of the call. That's the option right there. I highlighted. So that that additional money is the time value, okay? Because you're paying premium to buy out that, this is an option that expires a couple months out, about 2.5 months out. So the further out, the more expensive the option. The further in the money, the more expensive. So you'll notice as you get to lower prices of the strike, the option goes up. So some people will buy what's considered in the money, at the money, or out of the money. You'll hear those terms. In the money are these in the yellow. At the money would be a strike that would be right at where it's currently trading. And out of the money is in the white. These are ones that have no intrinsic value, no real value. They're not, the stock is worth less than the option currently. So they become cheaper, okay, as you get further away from the money, because that means the stock has to move further to increase the value of the option. So the further away from that number, the cheaper the option. But remember that options, most options end up expiring worthless. People that sometimes you'll hear the term will buy a lottery ticket. They'll buy a way out option hoping that something major happens. So right now, the odds of Apple hitting 180 or 185 in the next couple of months are probably pretty slim. The market's not anticipating that because the value of these options are pretty cheap right now. Hold on one second. Some people can't get into this class, so hold on one moment. Okay. So in the money, out of the money. All right. And at the money. And then the calls. So calls are purchased in anticipation of price rising. So let's say I think in 2 months, Apple's going to be trading at 175. Okay. I'm kind of anticipating a couple months. Some good news is coming out, earnings or whatever. I think it's going to be around 175. So I could buy the option, let's say the 160, that's out of the money a little bit, costs me $6.15. That's per share. So you have to multiply that by 100 for one contract. So 620 times 100 is $620. So it costs me $620 to control 100 shares of stock. Or if I want to control 1,000 shares of stock, that's $6,200, because that would be times 1,000. Then I would have the right to buy 1,000 shares at 160. Now you don't have to buy the shares. You can sell the option back to somebody else. As long as it goes up, then you'll make money. The problem is as time passes. So if, let's say in the next 30 days, Apple doesn't really move much. It sticks right around 154, 155 for the next month. What will happen is the value of that option will slowly decrease. All right. Over time value begins to evaporate. So the closer you get to current, the less expensive the options are. So you'll notice like the like these are expiring tomorrow, okay? So the 155 that expires tomorrow, that weekly option is only 77 cents. 77 cents for one that 155, and this one is 865 because um, you're paying for that time, right? By the way, if you have a specific question, you can ask it through the GoToMeeting chat. There is a chat for you to ask questions. Hold on. All right, you're in now, Paul, right? You can see everything. Y'all can see the screen, right? And you respond in chat. Can y'all see in here? Everything okay? I mean, I see it on my screen, so you should be okay. Great, awesome. Thank you. So, Bruce, you might there are some settings on. Bruce said I have a TD feed, but my Apple option chain screen does not look like yours. And so there are some settings. So you'll notice Apple, TD Ameritrade, calls and puts, list by calendar. I have near the money. So it only gives me options that are near the money. All expiration. And then my columns, I have a couple extra columns, I believe. I have Delta added in there. So if you want to take a well, I don't know if you can take a screenshot of this, but you should be able to set it up similar to mine. Kim has a couple of questions. Do you recommend buying a call or put or selling a call or put or just collecting the premium? Good question. So depends. If you own shares of a certain stock and you've had them for a while, um, selling calls against those shares is a good way to collect income. It creates an income stream. You have to be careful because if you're, like, let's use Apple as the example. Let's say you own Apple at $105, okay? 105. So it might be worthwhile to sell let's go to next week. Okay. So you might sell the 165, collect that 18 cents premium. Not a ton of money, but you've got over $10. It's got to go up over $10 in a week for you to get called away, right? And I wouldn't sell, against the whole position. Like if you owned 1,000 shares, you might sell a couple contracts against a couple of 100 shares. The flip side is, let's say you want to own, you don't mind owning Apple at 145, okay? You're happy to buy it at 145. You could sell the 145 put and collect 50 cents of premium. And then if it stays above 145, you keep the premium and you don't get the shares put to you. If it drops below 145, then those shares will get put to you at 145. So some people like to use an option, or if you don't mind owning it at the current price right now, you know, at 150. Well, let's say you want to buy Apple at 154, or let's say you don't mind paying 150 for it. Then you sell the 150 put, you collect that premium, and then if it stays above 150, you keep the premium. So the, a lot of people will do that. They will sell puts because they want to own that stock, and they'll pick a price that they don't mind owning it at. So that would lower your cost basis, right? If you sold the 150, you collect 100, one 143 143 per 100 shares, or 143 per share. So that lowers your 150 cost basis by $1.43. Now I'm not the expert in that area, and what is the best options, and to buy and sell. I'm giving you ideas. All right, so the next question Kim's asking is delta. And you notice I have delta here. Delta is a correlation of the stock price, the option in correlation to the price of the stock. Okay. This is one of the most important of the Greeks of options. The higher the delta, the closer to one, basically. So if it had a delta of one, that would mean it moves dollar for dollar with the stock. So a delta of 50.50 moves 50% of the price of the stock. In other words, if the stock goes up $1, then the option goes up about 50 cents. The stock goes down $1, the option goes down about 50 cents, roughly. So whatever that number is, so that's why these out of the money ones have a very low delta. They don't move, like this is 0.02, so it moves about 2 cents for every dollar the stock moves. The deeper in the money, you get the 80, 90%. They say a good delta is in the 60, 70 range. Typically, that's going to give you pretty good flow with the price of the stock. So one or two strikes in the money is going to get you something that's going to flow pretty well. Not dollar for dollar, but close enough so you don't have to pay too much premium. Yeah, think of it this way too. Correct. The higher the delta, the higher the probability of success. Lower the delta, lower probability of success with that option working out for you. But here's something very important, and I haven't stressed this yet about options. Options will expire, and when they expire, they can expire worthless. So you'll hear me sometimes talk about how I'll do a trade and it's an all or none. And what I mean is I only buy enough in what I'm willing to lose. It's so like Bed Bath and Beyond. I did that with Bed Bath and Beyond. I bought a put on BBBY and I said, all right, I'm willing to lose this much. Okay. I bought one contract. I forget what it was. It didn't cost me a ton of money. And that's, I think it was $1.70 or somewhere around there. So I was risking 170 bucks. If it goes worthless, that's all I'm going to lose. 170. If the stock dumps, it could go up 50%, 100%, 200%, 300%. I think I sold it with a 50% return. So with high risk does come high rewards, but also means high risk. Could risk everything. One thing I wanted to share with you guys real quick. If you are really new to options, I encourage you to go to cboe.com. Okay. Chicago Board of Options Exchange. Click where it says education and go to the Options Institute. And there's like a basic class, like articles and videos, Options 101. If you're totally new to options, take this course, okay? This will give you the very basics. I encourage you to take that class if you are new to options, okay? So now, if you are day trading a stock, okay, or you want to day trade an option, you need a higher delta. You need the 70 or 80 delta because you want that to be pretty fluid with the price of the stock. So let me give an example like that stinking Regeneron that I was in earlier. All right, let's look at the options on that. Obviously, it's a $700 stock. So a couple things. If there's a big spread between the bid and the ask, okay, it's probably not a good one to trade. You need tight spreads, no more than really about 20 or 30 cents. Some of the bigger price stocks will have bigger spreads on the options. Um, you'll see volume and open interest. Those are a couple of volume has to do with how many contracts have been traded, and open interest is basically the um, buy and sell orders out there, the interest in buying and selling. Okay. So options that have less than 1,000 contracts are typically fairly thin. So like these on Regeneron are pretty thinly traded. It's not it's not a good one to trade the option on. I mean, most of the volume is under 100. These are options, and the spreads are $2, $3, $4. This is not a stock you want to trade options on. All right, let's go to Tesla. How about Tesla? All right, so notice the volume on Tesla. You've got, a lot of the contracts are trading over 10,000 today. You've got a lot of open interest. So there's no problem getting in and getting out. And look at the spreads, a few pennies. Okay. If you're going to day trade a stock or day trade the option, this is the type of stock you want it to be trading the options on because it's very liquid, a lot of contracts traded, tight spreads. So it's easy to get in and get out. All right. That's critical. So here, let's look at Tesla. So if I wanted to short Tesla right now, okay, on a quick day trade, I'm just going to try to pick up, let's say, now remember, you got to think differently when it comes to options. Think of percentage versus dollars. So, and you'll notice some weird increments on this. It's because of the stock split. So there's some weird increment options. Some options have a dollar difference between contracts. Some are 250, some are 5, some are 10. Depends on the price of the stock. So this has some weird ones because of the stock split. But so if I wanted to short basically some Tesla, and I didn't want to, I can't short the stock because TD doesn't allow it. I could buy puts. I could buy some puts in anticipation that it's going to come down. So this is at the money, 285. Well, it's technically out of the money. 286.67 is right, and this is actually right in the money. So the delta is almost 50. So for every dollar the stock moves, this is going to move about 50 cents. If you want one that's a little more fluid, you're going to have to pay up. So if you want a delta of like 78 or 83, you're going to pay $6 or $7 for that to get more fluid. But if the stock rolls over and starts selling off hard, then the delta is going to start to increase more quickly. So let's say I think, and I wish it was at its highs and looked like it was going to roll over. But let's say this 286.67, which is pretty much right at the money. It's $2.88. So it's going to cost me $288 plus commissions, and it's a reasonable commissions to control 100 shares or 28,000 worth of Tesla. That's pretty good, right? So I can control $28,000 worth of Tesla for a couple $100, and it's going to move almost 50, half of the value. Is that right? Yeah. Two. Hold on. No, am I calculating that right? 2.93 times 100. Hold on. So if I want to trade it, then I click trade. Am I doing my math right? I think so. One contract. Yeah, $280 estimated value. 280. Yeah. Okay. So see how it's going up? Now it's 295. So it's moving around pretty good. Now it's $3, 305, 296. All right, I'm gonna buy. I'll buy one contract, maybe. I'll risk a little here. Ugh, I own it. What do I own it for? 293. All right, 293. So $293. Now it's worth 276. I'm gonna. I need it to roll over. But I'm controlling $28,000 worth of stock for a fraction. And it's going to move about half of the value of what the stock's moving. So if Tesla starts to roll back down towards VWAP, then this thing will start to pick up in value again. Now I could throw a limit out there. Let's say, let's see, 285.45 is where VWAP is. So if I think it's coming back to VWAP, 285.45, that would be over $1 in the money. But then So maybe it goes up 50 cents from here. So what it was $8 this morning for that put. So that put's gone from 8 down to 235 because of the movement in the stock today. So down here at the open, that thing was worth $8, and then it shot up, and now, so I need a little end of the day rollover. So I could put a limit. I could trade. So again, you highlight the contract you want to trade. Click trade, and then I could do limit. There, let's not get greedy. Let's just put 3.25. Sell to close. All right. So we bought to open. Now we're selling to close. Success. So now I have an order sitting out there. If Tesla rolls over, then it may hit my limit. That does expire tomorrow. So notice the number 1 next to it. That means 1 day to expiration. Now I could hold it till tomorrow. I could hold it till tomorrow, and if the market's down and Tesla sells off tomorrow, then I might do okay. Or I can turn around and sell it right now and lose $20, basically. Yeah, I lose about $20. Yes, Linda, the most I can lose is $293, what I paid for that option. So I know my risk. I know my risk. Now, if I was trading 100 shares of Tesla, that same 293, I could lose, obviously, if the stock drops or went up a few dollars. Paul, yeah, I heard the news. So, like I said, I like to use options when, like, there's a stock like Bed Bath and Beyond that's made a crazy move, and I can't short it because there's no shares available, and I'll take I'll buy one contract and just trying to catch a good move down, which I did, and actually had I held it to the next day, it would have, I think it was more than doubled, but I got a 50% return, so it made sense to go ahead and get out of it. And I can place a stop on this as well. So I could put a stop at $2. So then really the most I would lose would be $93. Or I could put a stop at 250. Then I'm limiting my loss. So it's starting to move back up again. I'm almost back to even. There's that 290, 293. So if it rolls over here, it'll start to pick up some steam pretty quick. You don't have to do anything, Bruce. It'll save it automatically when you add columns. It knows. you're good. Yeah, Paul. So basically, I bought a put. So I anticipated that Tesla would roll over. So it's just like shorting it. So it's like I shorted 100 shares basically. But instead of moving right at the, dollar for dollar with the stock, it's going to move at about half of that. So for every dollar the stock moves, the option is going to move about 50 cents roughly. That has to do with the delta. And the delta will start to rise if it moves more my direction. If it moves away from my direction, then the delta will start to fall. Delta goes up as you get more into the money. So it's trying to, if it rolls over here, then the delta will start. See, now we're back to 48. We were at 47. So this number will rise if the stock starts falling and the option increases in value. We're almost back to even. I can turn around and sell this right now. Yes. I have until tomorrow. I have to do it before tomorrow. I have to get out of this before the market close tomorrow. But yes, you can buy and sell. It's just like trading stock. Bid and ask. I just wish I could get one good little drop of about $1. That would really shoot up the value of this thing. Oh, I can even do a bracket. Here, let's do that. Let's cancel this order. Hold on. I'm going to do a bracket. I just want to protect myself if it rolls over. 255, 325. So I'm limiting my loss here. All right. So now I have a bracket order. So I have a stop and I have a limit to take profit. Here we go. Oh, shoots down and shoots back up. Started to look good. Do you have to do the add-ons for each new stock you look at? The add-ons. No, once you save the layout, it doesn't matter what stock you look at. Is that what you're talking about? Yeah, we almost got to 50 on the delta. But it's interesting. See as we drop the value, look at that 305, 310. See how quick that thing started jumping in price? And there's the delta's 51. 315, 320. So I might get hit at 3.25 here in a minute, maybe if I'm lucky. Got close. Honestly, if we get to anywhere near VWAP, it'll hit. And it looked like it was about to get there. It was making the run towards VWAP. And then it just rips right back up. You can probably, good question. I don't think the flatten button works for options. I think you have to, I don't think you can, hold on. I'm almost positive you cannot flatten. You would basically have to cancel any open orders, put a market, and then just close it to market. I don't think there's a way to flatten. Oh, that stinks. We got so close. I actually had profit and I couldn't react quick enough. It didn't. Uh, maybe you know what, Bruce? Maybe you needed to close it and then reopen it because mine carry over. I don't think you have to save anything. Said it didn't seem to auto save my add-ons when I switched. Oh, you got it. Okay. Yeah, it should. I'm probably going to get stopped. It's bouncing. That sucked. Almost had it too. So this is a good way to, you know, find what you want to do is if you're going to trade actively, you have to find stuff like this that's got a lot of volume, tight spreads. Um, most of the FANG stocks, Apple, Amazon, they have plenty of open interest and volume, tight spreads. You don't want to be doing this with a stock that's got low volume, low open interest, big spreads. Definitely, you don't want to be actively trading um, the option. Now, if you're just strictly looking to um, so this is more of the active side, but you can also if you can do swing trading and position trading. Swing trading, you probably need a delta around 60 or 50. Um, Position trading, you could probably go with a 40 because you're giving it time. But active, you want it depends on the stock. As long as the stock moves around, like Tesla moves around a lot. So a 50 delta or higher, you can trade actively. It's going to be pretty fluid. All right, it's trying to roll again. Here we go. Starting to run up. All right, I'm going to move down my limit. I got to go over to my other screen, and I'm going to move up my stop. Hold on. Cancel, replace. I want to change my limit to 320. And I want to change my stop to 270. Then I only lose $23. Okay. I'm kind of tightening up a little bit here because we're running late on time and it's not it's not rolling over for me. So if I lose $23, no big deal. But it is interesting to watch how those options, they move with the price of the stock pretty well. Every time this thing starts to roll over, that option value starts jumping, and then as soon as it bounces back, and then it starts dropping. Yeah, Paul said it'd be nice if we could see the chats from the other trade. Unfortunately, this doesn't do that. It only lets me see it. So, the stop allows you to limit the amount that you lose. So even though technically I'm risking the $293 by using a stop, now I'm only risking 23, 20, $25 max. For active trading, Linda says, should you use a super close expiration for active trading? Yeah, if you're just day trading, you can use the weeklies. The, they're going to have more volume. They're going to be the ones that are traded the most actively. So yes, you would want to use the weekly, the closest time, because you don't want to pay extra for time value because you're just going to day trade. If you're just going to end up paying more to utilize that option. There's no need to do that. Now you know what's going to happen, right? I'll probably get stopped out and then it'll roll over and drop $1. But yeah, I typically just trade the current weekly option. And I don't do this real frequently, but every once in a while I'll buy a put or call and depends on the situation. We just need that one push down to VWAP and then I get there. Nope. They keep pushing it right back up. Nope. That was it. I got hit. What? Something, something's not, something's not right. It says I made $288. All right, guys, any questions? I just have a couple minutes left. Let me see what it shows over here. Okay, so I paid 291 and I sold it for 270, so I lost 21 bucks. That's what I lost. 291, 270. Oh well. Any other questions about trading options? This was kind of a quick overview and kind of a how-to. I wish that would have worked out. It would have been nice. Actually, was in the money for a brief amount of time. Oh, look, here goes. Yep, watch. Now it's going to turn and rip. That's all right. I had profit. I just couldn't grab it. I'm also happy to do another session on this and kind of just, we can do some trades and um, I'm happy to spend more time on options. Oh, rolling back. Oh, good, cool. Linda says this was good. Let's do that. All right, guys. Well, again, just a reminder, if you are new to options, go to CBOE and click on the Options Institute. They have an Options 101 course. This is a great starting point just to learn the basics. And there's some other, like, online, if you just Google options trading, you can find some other online classes and whatnot. But the CBOE one's pretty good. And Bruce also says, let's do more. Thank you. Yep, happy to. Thanks, Paul. I don't think I'm going to play tonight, but thank you. Anyway, thanks, guys. Have a great afternoon. And as I said, this is recorded and probably by tomorrow will be up on our YouTube channel, our YouTube page, which you can get to from equity-alerts.com. Have a great afternoon. Bye-bye.